I don't do a lot of paraphrasing of the Clinton administration, but I am in this case. And I think the real thing that we need to remember in this entire situation on current economics is this is all driven by costs. This whole situation that we're in now from loss standpoint really is a function of the cost of production of raising hogs. As we look at the next slide, this is a representation of Iowa State University's estimated costs and returns, the cost estimates from those figures. The red line there, the blue in the back is the actual, the red is a prediction equation that I have that just uses corn and soybean meals. And notice that for the future out through the end of 2002, this model now predicts, based on futures prices for corn and soybean meal yesterday, break-even prices of almost $69 a hundredweight. That has gone up about $4 a hundredweight since August, as we've started seeing grain prices increase. I don't know that there's a lot more top side in that, but I don't think there's much bottom side in it either. And so as we go forward, I think we're going to be dealing with these costs. Now, those aren't nearly as high as a year ago, but they're still over 30% higher than our historic cost levels were. And if we put hog prices, which is the green line in this chart, on top of that, we see that had costs equal to that $52 and change that we historically had cost at, we wouldn't have lost money on a hog yet. And that's kind of a shocking thing for some people to consider. But this has really all been driven by cost. We had record high prices last year, and yet we've seen about almost 2 solid years now of substantial losses, and with only a couple of years of profits and a couple of months of profits last summer. Now, a near record corn crop is going to help. That corn crop got a little smaller last week when USDA released their most recent crop estimates. I suspect it might get a little smaller yet, given the difficulty we've had with harvest. We caught up a lot here in Iowa in the last couple of weeks, but still, this is going to be the second largest corn crop on record. There's very little doubt about that. And if we combine it with carry-in stocks, this will be the highest corn availability we've ever had. And yet, USDA is forecasting prices at $3.50 per bushel. The average of the futures prices as of yesterday was $3.64 for this crop year. A tremendous growth here in prices. When we look at the basis, the normal cash basis relative to this USDA forecast, and by the way, that's a season-long average farm price that USDA is forecasting. The basis has been, it was 63 under this last year for Omaha corn. It was 65 over the year before, so it bounces around quite a bit. It's hard to say what cash corn is going to be based on this, but still, this is not a lot less expensive corn than what we've had the last year, in the last crop year. If we go on, what does this mean as far as prices? Well, I think we see this new kind of level of prices from 3 to 4.25. Corn has stayed in that range except for the big spike last summer when oil went to $140 a barrel. And that is going to be a driver. It's going to be a driver from here on because we have certainly hitched the price of oil, the price of corn to the price of oil. This is a scatter diagram that shows weekly observations since January of 2008 for the price of crude oil, West Texas Intermediate crude on the horizontal axis, and cash corn price at Omaha on the left axis. The darker black line here is just a regression line fit to those points, and until last summer, which I've got noticed there, I cut off the word July, I guess, that cluster of observations right around $3 per bushel. The black line, the dark black line there, had an R squared of 0.93 or so. It had explained almost all the variability in this relationship. Now, this past summer, we had some relatively low corn price observations, but I would direct your attention to the little cluster of dots. They're right around $80 and just a little bit less per barrel on oil and just under $4 on corn. Those are the last four weeks observations in this chart. And so we see this relationship kind of returning to normal. December crude futures yesterday were at $79.14. November of 2010 futures were at 85. And if you look at that that says that Omaha corn ought to be somewhere 420 to 450. So I sure think there's some topside in this cash corn market as we go forward, and that's obviously not good news. But probably the low for corn is in. I would say that producers should have had a lot of their feed price costs locked up, and if not, they can still do that. Of course, it's not quite as good a deal as it was. The driver here is ethanol. I mean, the usage of corn that has grown over the last 5 years is ethanol, and it's certainly taken a lot of corn out of the market. Those record supplies are great, but when you had one usage that has grown by a factor of 6 in the last 6 years, it certainly is a driver. That will increase again by about 300 million bushels in the next crop year or the next calendar year as the renewable fuel standard goes up. And one of the points to be made right now is that ethanol production is now again profitable. This chart shows the total ethanol price is the top of that buff-colored area that you see. The buff-colored area is cash costs other than corn. The red is corn costs, and the blue is margin above corn and other operating costs. And as indicated here, Iowa State estimates that you need about 25 cents a gallon just to cover the fixed cost involved here. And these plants have moved back into a profitable area since July. This is a very competitive business. And what I think is going to happen here is the ethanol plants will chase corn and bid the price of corn up until they push those profit levels back down to almost zero. That's the nature of a competitive business. And so I suspect there's going to be some upward pressure on corn, mainly driven or partially driven by these the profitability of ethanol production. Ethanol production is still growing. We have about 200 plants operating in the U.S. There are a few still being expanded. But one of the things, as I made a point earlier, is they really have kind of tied the price of corn to the price of oil, at least above certain levels. The top horizontal line here is at $70 per barrel on oil. And notice that when oil has moved above $70 per barrel, corn has moved right with it. It did it last year. It has started doing it again just recently. Anytime oil is kind of below 70, there's some correlation there, but it's not nearly as tight. And so I think this is going to be one of those things that each day for what happens in the corn market, we're going to go over and look at crude oil futures again, just as we did last year. And this is a linkage that is there, and it's there to stay. I don't think we can't unring the bell on ethanol. And the reason is the plants are in place, and somebody's going to operate them. Most of the Verisun plants are back up and operating now. Of course, they were shut down last year, and we shouldn't be surprised by that because, as I understand the hotel business, the third owner of a hotel usually makes money. I think it's going to be maybe the second owner on many of these ethanol plants. FAPRI at the University of Missouri and Texas A&M took a look last summer at some different policy alternatives on ethanol. And what they did was they took 500 draws of some random variables and computed what happens to corn price, ethanol price, the amount of ethanol produced, a number of variables, and under several different scenarios. And one of those was to remove the blender's tax credit. And if they did that, they estimated the average corn price from 2011 through 2018 would go down by 0.6%. Okay, that's 1.8 cents on $3 corn or 2.4 cents on $4 corn. If they remove the tariff that protects the domestic ethanol business, corn prices would go down by a little less than 3%. If they remove the renewable fuel standard, which is kind of the big one that guarantees a market there, corn prices would only go down by 4.6%, and this is on average across all these random variables for a 7-year period or 8-year period. If you removed all three of them, they'd go down 13%, or about 40 cents for $3 corn. So as you can see, I mean, it doesn't matter a lot what you do now that the plants are there. You're not going to have a big impact. There's still the question next year of whether the blender's tax credit and the tariff will be indeed allowed to expire. They expire at the end of 2010. There's going to be politics obviously involved in that to make that decision. But there is some some sentiment to allow these to expire. Just recently, the GAO published a report that basically said, if you don't have these in there, it doesn't make much difference on the amount of ethanol we make and the price of corn. So why aren't we collecting this tax money? And as a taxpayer, I ask that question too, since I understand they're a little short on tax revenues in Washington, D.C. these days. And I'd rather it be on somebody else and not me, as all of you would agree. We still need one thing, in my opinion, and it's something that will be discussed. I don't know if there's much chance of it, but it would certainly be nice if we had some kind of an automatic trigger on the renewable fuel standard to basically set it aside, or at least reduce it dramatically, in a case where oil is relatively cheap and we have a drought. That situations, the market would tell us that we should burn gasoline in our cars for a year and feed the corn to livestock. But right now, with the renewable fuel standard in place, we can't do that, and we can't do it very quickly. And that decision is still in the hands of the administrator of the Environmental Protection Agency. And this summer and fall, I've run just kind of an informal poll at meetings, and I have had no one yet vote that they thought that the administrator of the EPA would have the best interest of the U.S. livestock business in mind in making that decision. And so the vote is probably 3,000 or 4,000 to 0 right now on that topic, and that's the reason I think we need an automatic trigger. To restore profits in this kind of environment, the only thing that you can do is cut production, and we're doing that. Chicken production is down over 4%, turkey production down over 5%, pork production is down a little less than 2%. It would be down more than that if we hadn't sold pigs the size of small horses this summer. And beef production is down a little over 3%, and it would also be down more had we not sold cattle that were the size of large horses this summer. So weights really have worked against that, mainly because of weather. This summer we would see larger reductions, and these reductions are going to continue. I think the chicken and turkey reductions will slow a bit as we go through 2010. I think the pork production will get larger as we kind of get back to more normal weights, and we do get some reductions in the number of pigs. And the beef production will probably stay in the 2 to 4% range, but will probably last longer than the others, as it just takes a lot longer to have any impact on beef output. These reductions are, again, driven by higher costs. I mean, we'd all like to just increase demand and cover those higher costs, but it can't be done that easily. If we look on the hog side, this is my index of hog feed costs. Notice that it went from about $180 to $200 a ton back in June, all the way down to about $150 a ton in late September, early October. That's increased about $20 a ton during harvest this year. And so once again, we've had a very low, early seasonal low in corn and soybean meal markets, and it had some strength since then. Obviously, we're very concerned, and there's growing concern about the South American crop as well, especially in Argentina, where dry conditions there are preventing both corn and soybean planting in recent weeks. Let's look at demand for a minute. Demand has been a bright spot for hogs, for pork this last year, especially domestic demand up about 4%, while demand and broiler demand have both declined this year. Last year was the first year since the early 70s that all three of those had been in the same year. It's a difficult situation for all of the species. The real thing to note on these demand indexes is that the trend is decidedly bad. All of them peaked in 2004 or 5 in the case of chicken, right around the Atkins diet, impetus behind meat demand. They've gone down pretty much ever since then, except for year before last on pork again this year. So, but still, kind of a downward trend that has to have us concerned. If we look at this, what I have on this is that use a retail price series from USDA that doesn't show much downward impacts of featuring. We know that there's been a lot of featuring on pork this year, and yet you can see the line there gone down very much. That concerns me a bit because I think the actual retail price is a little lower than what USDA has done. If this retail price was closer to what I think was right, it would drag that index that we saw on the previous slide, and I'm not even going to try to go back there. It would drag it down a bit. Now, I've done a little calculation. I don't think the year-to-date index for pork demand would be lower than a year ago, but it probably wouldn't be up quite as much. It wouldn't be up 4% as was shown on that other one. Still, it hasn't been a bad year on domestic demand. We have sold a lot of product, and we've been able to maintain prices at reasonable levels given the amount of supply that has been placed back on this market this year by A, H1N1 export restrictions, and B, extra production, especially in the form of higher weights this summer. Of course, the story last year on the demand side was exports, which were up 50%. And the question at the time was, is this permanent or transient? Well, it has proven to be a transient thing, one that wasn't going to stay with us for long. It was really a confluence of several conditions. One of them was a record low U.S. dollar that made our product relatively cheap, and on that vein, we're getting back there, and I think that's going to be positive for exports in the coming months. China, Hong Kong, of course, was the big driver, driven by their economy and a rising middle class, driven by their need for pork due to death losses back in 06 and 07, and, of course, driven also by the Olympic Games and a very strong interest on the part of China's leaders to make sure that 1.3 billion people didn't take to the street protesting shortages of pork. And so there were a number of drivers there, including economic growth in other countries. Mexico was quite strong. And, by the way, Mexico has been stellar this year, especially in the face of the H1N1 situation. We had a tough May and a little bit of a tough June. Exports to Mexico were like 60% higher in September than they were a year ago, and so the business there continues to grow. And the last factor was a very strong Canadian dollar that made their product relatively non-competitive or less competitive in world markets. So last year was a lot of things came together, and some people might have thought those were going to go on forever, but they obviously have not. And here you can see monthly exports, and I guess the real message of this one is when we compare this year's exports to the 2004 through 2007 trend represented by the red line, they haven't been too bad. As a matter of fact, we've only been below that trend 3 times, and for the year to date, we're up about 5% relative to that trend, even though we're still down about 17% from a year ago. Again, I don't think it's a fair comparison to compare to last year, and it looks to me like exports are quite good. But the combination of these lower exports relative to last year leaves hog demand lower than it was last year, and that's certainly been a negative for hog prices this year. On the supply side, I think we're still living with the shock that occurred in 2007, and that was when circovirus vaccines were introduced, and we saw a dramatic increase in slaughter in the fourth quarter of that year on a salary that was only up about 1%, and it was just a matter of livability. You see that we've run slaughter totals back up to about 2.3 million head this fall. I think that's as high as they're going to get. We're about steady here for the rest of the year, and I'll show you that in a moment. But the point is that we certainly moved to a new product output plane when we solved some of these death loss problems with circovirus vaccines. And then the secondary impacts of these have really stayed with us for some time. And right now, what we're living through is just a rapid growth rate in productivity from a litter size standpoint. We've averaged 2.1% since the third quarter of 2007 that's 9 straight quarters. The only time we can even rival that kind of increase in productivity was in the mid-90s. And back then, we were changing away from less efficient hog farms toward more efficient hog farms. And right now, we're doing a little bit of that because some less efficient ones are going out of business, but not nearly the kind of structural change pace that we had in the 90s. This one is real gains in productivity. In addition, these gains in productivity are offsetting to a large degree sharp reductions in the number of pigs coming from Canada. We drove the market hog numbers down to right at 10,000 a week with the advent of mandatory country of origin labeling last October. The number of feeder pigs or weaner pigs keeps declining and will continue to do so as the Canadian herd gets smaller. And so, even though we have far fewer pigs coming from Canada, we've had slaughter levels very close to last year for much of this year, and I think we're going to continue to see that, but some negative impact in Canada will start tightening supplies as we go into 2010. On weights, of course, very mild temperatures this summer resulted in tremendous hog performance. You can see here we had, I think, 4 days over 90 in Des Moines, and the pigs have just performed extremely well. We're finally back to year-ago levels on carcass weights after being as much as 6 pounds heavier this summer. I think as feed prices rise, we're going to have some pretty strong incentives to keep these carcass rates near year-ago level, at least through first and second quarter of next year. If we look at what was predicted back in June, and this chart shows, the red line on this chart is predicted slaughter based on the June Hogs and Pigs report. Notice that the actual slaughter, the blue line here, was above the predicted slaughter for much of July and August. Part of that was due to very short slaughters in the middle of July when packers took a couple of floating holidays. But still, this extra production and the extra weight of those pigs was a huge weight on this market in August, and is one of the biggest reasons that we had the big sell-off in August. We'd like to blame H1N1, but I think the impacts of H1N1 were well behind us by the time we got into that August supply situation. And while demand wasn't great, and yes, the Chinese weren't buying, but the Chinese weren't buying much before they put their blockade on. I believe it was really one driven by extra production as we get into late summer. That brings us to now. September Hogs and Pigs report said we have about 3% fewer sows in the country, and notice that the actual numbers in the middle column are pretty close to the pre-report estimates. The problem is that over the last 2 or 3 quarters, the pre-report estimates have panned out to be closer to actual numbers than what the USDA numbers have. But still, we're going to run with the USDA numbers now, down 3.1% on the breeding herd, down 2.2% on the market herd, which would suggest lower slaughter through the fourth quarter and the first quarter of next year. June through August farrowings down 3.5%. That fits with the breeding herd reasonably well. But notice the pig crop, only down 1.6% from a year ago, and the reason is the number in bold black right below it, another 2% growth in litter size. Now, of all the numbers in this report, the one that gives me the biggest concerns are the Sept and sped farrowing intentions, because they're exactly the same as the decline in the breeding herd up above. Now, the fact that they're exactly the same does give me a little pause that someone might have engineered the numbers, but I'm not too worried about that. My concern is the cool temperatures this summer that cause that rapid growth rate are also going to cause excellent conception rate. And so I think we're going to get more litters farrowed in these winter quarters, fall and winter quarters, and have more pigs in the second and third quarter of next year than what this report on it, just the numbers that are in it, what this report would actually tell us are on their way. So here's my forecast for slaughter for the next, out through the third quarter next year. And notice I do have lower slaughter, about 2.4% this fall. We've been very, very close to those numbers. So that's looking pretty accurate. Green line is the actual numbers in this graph. First quarter of next year down almost 4%. A big chunk of that is fewer Canadian pigs. And then the second and third quarter down only 2.5%, even though we had farrowing intentions down over 3%. The biggest reason being what I'm afraid it will be a few more litters than what we expect normally out of the numbers from the USDA Hogs and Pigs report. We have had a nice little rally in cutout value here recently. As a matter of fact, this is the first October and November rally in cutout value that I can find in my data set, which goes back to 98 when we changed the cutout value calculation. That ended last week with a slight decline of about $1.40, but still this has been a pretty nice run here for the time of year when normally we're going the opposite direction. And given where we've been all year, we'll take about anything we can get. Hog price changes have been right in line with that cutout. Packers have shown a lot of discipline on these pricing issues. The first half of this year they didn't do that, and their margins were just awful. They've been about normal on margins since that time, and I think we're going to see them fall pretty close to that. Sow slaughter has jumped back up. I think the last couple of weeks It had fallen back down to about 66,000 a head for the month of October. The green lines are based on USDA sow purchase data and give us a little bit of a view within 2 weeks. It gives us 2 weeks more current view of what sow slaughter might be. It looks like it's going back up into the mid-60s. But one of the points I would make is that the proportion of that slaughter has been much larger of U.S. sows recently. Notice the total sow slaughter was still below a year ago, but U.S. sow slaughter of U.S. sows, is about the same as a year ago, and in fact was sharply higher than a year ago, 2 weeks ago, the last data that we actually had. So I think we're going to see this come back up some, but it's hard to get a whole lot of sow herd reductions if you've got $75 futures hanging out there for next summer. Here's the percentage changes. You can see that Canada was down 4.5% in October. The U.S. down 3.1. I had thought that those numbers would accelerate through December. I'm not sure that that's going to be the case now, especially with the rally we've seen in futures prices that's offering some profit potential out there. I think we're going to slow this reduction down again, and see that another negative for hog prices mid-year next year and into the fall. Producer equity was record high 2 years ago. It was one of the reasons we've been very slow to react to this, but it's now down by over two-thirds, and it's still going down. The bankers are going to talk about this in a potential is going to be the decision of staying in business for many producers. It's going to be, do we have enough cash to last? We've seen some of that in some publicized recently. One of the things that has kept some people in business has been the fact that they did a good job of pricing hogs out on the future, which is the pink line here, the other market formulas, or at a price tied to feed prices. Now, the red line here is other purchase arrangements, which is basically feed-based contracts, and so they kind of have a floor in them. There aren't a whole lot of those out there, though. On the other market formula, the pink line, there have been quite a few of those the last couple of years, and producers have either done that with packers or hedged hogs on their own. Another way to look at this advantage of these two is just look at the differential of the other market formulas and other purchase arrangements versus negotiated, and you can see that there have been times when some of them had a $20 per hundredweight, roughly that advantage in the last year. That has insulated some producers, given them a lot more staying power than the industry as a whole, as we've gone through these losses. So, supply forecasts, I present here Missouri's, Iowa State's, LMIC, the Livestock Marketing Information Center, and my own. You can see the percentage change numbers over in the right-hand column that you saw a while ago. I think we're going to have a little more reductions in the first quarter than some of the other analysts, but less in the second quarter, less than what Missouri has, and I think the difference there is my thoughts about what's going to happen to farrowing rates. On the price side, a lot of difference among our forecasts here. I told Glenn Grimes and Lon Plain that when they did these forecasts, they'd take their pessimist pills that day, as they're very pessimistic. I'm not quite as optimistic as some others, but notice over on the right, this is futures as of last week. I forgot to update that, Ned. I'm sorry. Yesterday, these would have been about $1 or so higher than what these numbers are. They're way higher than any of the cash forecasts that we had. And I'm always a little loath to say that futures markets are wrong because there's a lot of information that goes in there, but to me that says that's a selling opportunity to book some hogs out on the futures, lock in some profits, and hopefully take care of some of your business. Finally, what's the impact of this going to be on the pork industry, and how is it going to affect rural America? And I got a typo here, Manette. It should say for each 1 million head fewer market hogs. I'm sorry. If we took out 100 million, it would have a few more jobs than that, I think. But for each 1 million that we cut back, we're going to cost 330 production jobs, about 680 processing jobs, and about 1,140 jobs in the rest of agriculture, or almost 2,150 jobs, most of those in rural areas. I think we're going to take slaughter from 116 million year before last down to probably 106 or 7 million here next year or in 2011. If that's the case, we're going to take out over 20,000 jobs, mainly in rural areas. And the impacts of that are going to be terrific. Now, some of that will be made up with some energy jobs, perhaps, but the trade-off there is not good. If you do the corn to run a 100 million gallon ethanol plant, will cost about 1,000 jobs in production, in hog production, if it comes out of hog production, while creating 70 to 80 jobs in the ethanol plant. So the impacts here could be great. I guess the conclusions we have is, number one is there's still going to be a viable animal protein sectors in the United States. And there's going to be a viable hog business in the United States. We're very competitive on a world basis. All of these sectors, including hogs, will be smaller than they have been. When costs go up 30%, you can't move demand that fast, and so you have to reduce supplies in order to get profit. The challenges are going to be great and sometimes frustrating, as all of you have already gone through, and they're going to limit our choices, and that means higher costs. The challenges coming from outside the business. U.S. consumers will pay more for animal proteins in particular and food in general, and the question is, will they stand for it? And finally, obviously the question of the day is, how are you going to cope with the challenges? I think one of the answers is more risk management, more effective risk management. You're going to have to work very closely with your banker and others. And then there's some real public policy issues, and I think Jen Reiner is going to talk about some of those that we're all going to have to get involved in very soon. A couple other sources of information that I work on. I do a daily livestock report sponsored by the Chicago Mercantile Exchange. We'd love to have you try it. You can go to this website that's on your screen and subscribe to that. And then National Hog Farmer does a weekly that I write in on as well, and there's the subscription information for that.